Hi guys, welcome to this lesson on professional traders, position sizing tactics, and understanding what is a basic trading orders and also advanced trading orders like the one cancel another order, or we call it in short OCO order. I'm going to do a live demonstrations on how to implement to do your sizing, okay, using our Excel sheet and also placing orders in Think or Swim software. Okay, so let's go through understand first what is some of the basic concepts in trading orders and this thing called bid and ask. So what is an ask price or an offer price? It's basically the price that the market is willing to sell the particular asset. So in this example, right, I'm just going to go through uh, this McDonald example, right? In all platform, you're going to see a bid and the ask, okay, the buy side and the sell side. So for example, for McDonald's over here in Think or Swim, right, in your main window, you can see that there is this bid and ask. In any trading platform, you're going to see a bid and ask for the stock, the futures, or even the forex that you are trading. Okay, so let's say over here, right, the bid is 127.73 and the ask is 127.90. Okay, so anything lower will be 127.72, 127.71, 127.70. Anything higher will be 127.91, 127.92, 127.93, and so on. Okay, so you have your, on the left column is what we call your, right, your bids. And over here on this column will be your offers, okay, or us. So in trading, right, there's a lingos that traders use. So whether we call it offers or ask, it's the same thing. Okay, I have no idea what's the difference, right? So I also learned that for the sell orders, it's either called offer or ask, but on the buy orders on the left column here is called the bids. Okay, so the difference between the bid and ask over here, right? The difference is what we call the bid ask spread. So same thing, like for example, if you go to a money changer, when you go to a money changer, let's say you're going for holiday, let's say to Bangkok, you need to exchange your home country dollar or Sing dollar for the Thai baht. If you buy and sell at the same time, you will lose this thing called the bid ask spread. So in the market maker also quote the bid ask spread onto the platform that you're trading. Okay, so the difference is called a bid ask spread. Okay, so there are some kind of orders here that very basic orders that, okay, you traders will use. Okay, at the end of these slides, you can actually read more about the basic orders that I'm going to cover in this video. So over here, just focus on what I'm going to go through first. Okay, more details on the basic orders is at the back of this handout. Okay, so let's say for example, if you want to just buy the market, let's say traders just want to do this thing called a buy market order. When you use a buy market order, basically you're telling a platform, the trading platform, that you want to just buy at any price, the most available offer price, which is in this case, if you put in the buy market order, you'll fill at 127.90 because that's the most available, the lowest available offer that the market is going to fill you. Same thing if you do this thing called sell market order. Let's say do a sell market order, right? And for traders, some traders we use this thing called a sell stop market order. So when you put a sell stop market order at a specific price, okay, the platform is going to fill you at a specific price at market. That means you sell at any price when it's being triggered. If you just want to sell market at any price right now, you can just put in the sell market order. Okay, so you ask me what if, for example, you do not want to just buy the market straight off, right? Maybe when you look at your chart, your strategy structure decide this thing called sweet spot that I'm going to teach you in the next subsequent videos. this thing called sweet spot. Okay, you may want to wait for price to come back down, right, for a better entry. So for example, let's say McDonald's, you want to fill the order at 127.71. Okay, you want to wait for the market to come back down. You don't want to buy straight away at 127.90. You want to wait for the market to come back down to 127.71 to fill your order. You'll place this order called a buy limit, the buy limit order. Okay, when you place buy limit order at 127.71, in layman language, you are telling the platform that you want to buy at 127.71 or below. So the platform will never fill you at any price higher than 127.71. Understand? So for example, if today the market, you put a buy limit order and the market gap down. When the market gap down, right? For example, you trade stocks, right? You put a GTC buy limit order. A GTC means good to close, means the order will be there forever. And if today the market gap down, let's say to 127.70, and your buy limit order is at 127.71, where do you think you will get filled, right? Because you put the buy limit order 127.71 and market gap down to 127.70, you will be filled on your buy order at 127.70 because you told the platform that you want to get a price at 127.71 or better, right? So now there's a better price, so the platform will fill you at a better price at 127.70 immediately. Okay, same thing for the sell side. For example, you buy a stock and you want to sell much higher, right? Let's say you put order at 127.92. You put a sell limit, we call it the sell limit order. When you put a sell limit order at 127.92, you are telling the platform that in layman language, you want to sell at 127.92 or higher, right? So the platform will never will fill your sell order at any price lower than 127.92. And let's say, for example, again, let's say you put the target order, let's say you take profit order, you're long, you put a take profit order. Pre-market, let's say the futures went up 1,000 point, right? And then when the market opened, it gets above your sell order. Let's say when the market opens is at 127.93 and your sell limit order is still there, the market will fill you at a much higher price, which is at 127.93, because you told the platform you want to sell at 127.92 or higher, which is a better price. Agree? So now you understand what's a buy market, sell market order, what's a buy limit order, and a sell limit order. That's the foundation of what we call basic trading orders. And what do we mean by join bid? So another way of calling a lingos of when we use a buy limit order is that we use this term called join bid. So join bid is basically a lingo to say that you're putting a buy limit order. When you say that you're putting a join offer, you're basically putting a sell limit order, right, to queue up in the market. Okay. And of course, like I mentioned, there's this order called GTC, GTD, and GTC, right? GTD means good due day. If you put the order with a time configuration as GTD, and the market closed for today, your order will expire, right? And if you put an order called GTC, good due cancel, right? The order will be there forever and ever until you personally cancel the order. Okay, 99.99% of the time I use GTC order, right? Especially when I enter the position using the OCO bracket, I will leave it as GTC because I want to do my own things and I do not want to worry, the order expiring. I want to have the certainty that the order will be there forever to help me take profit when it reach a certain price, or help me stop loss, right? If it goes against me, to get me out of the market even when I'm not watching, right? Okay, so we'll cover more on the OCO order very shortly. Okay. So you can read up more about the market orders I mentioned, the buy limit order, sell limit order, stop order, and protection order that we typically use in trading. Okay, we do not, when you enter orders, right? Okay, my students know all of us are supposed to do a buy limit order or sell limit order. Even if you want to buy at the current market price, let's say if you for example you want to buy at 127.90, you are satisfied with the price. Now instead of putting a buy market order, you can also still put a buy limit order to get filled at 127.90. So 99.99% of the time you're going to put a buy limit order to buy to get in your position to go long, and to go short you're going to put a sell limit order. Okay, so over here in money management, we're going to look at this very important concept in trading. Is called expectancy on an edge, and this is something that all traders need to know in order to be profitable in the long run. Okay, so professional traders like us, we look into our trades as how much we expect to make when we win, and how much we expect to lose when we really lose. There's going to be some losses along the way. It's normal. In fact, professional traders, we know how to minimize our loss, and when the opportunity comes, we're going to make more than we lose. Okay, this concept is the same as a very savvy businessman when they do a business, right? Of or even a poker players on how he calculate his odds of winning, or even the casino, right? The casino is not afraid of players going in to play with him, because the casino knows that they have an edge in the long run, right? They will make more money than they lose. So in the trading, it's the same thing. When we take on a particular trade, right, we rely on our strategy to give us this thing called an edge in the long run. Okay, and this is actually a mathematical formula called expectancy, or refer to as edge. And of course, we traders, we when we trade the markets, our purpose as a trader is to churn out positive returns, right? And we look at how much we win, right? Where and our probability of wins, right? So probability of win times how much we win minus probability of loss minus how much we lose. When we really lose, will and whether the expectancy is positive or negative will tell us whether we have an edge in the long run. Okay, so in the long run means that let's say you're trading for 3 months, 6 months, or even 1 year, you want to see that even though there are times when you may be down in certain trades, or even a short term losing streak, in the long term you want to see that you make more than you lose. This is actually the function of traders, and you must be able to accept losses, controlled losses, right, in the short run, right, for the longer term purpose of making more returns. All traders, even professional traders, at times will have their downtime, or we call it rough patches. Okay, and even in the trading desk, the one of the most important thing we look for is that the trader can manage his risk consistently. So a trader, even if he can lose 10 or 20 times in a row, but he manages his risk consistently, we still call this trader a very good trader. Rather than a trader who make big, lose big, sometimes he make very small amount, but when he lose big amount. This kind of traders is what we call a time bomb. So risk management is of utmost importance if a trader wants to be do trading long term. Okay, so you have to train the psychology thing as a training as a game of probability, where the edge is achieved in the long run. Okay, so I'm going to give you an example. Okay, so let's say for example, when a trader lose, let's say there's only 5% chance he's going to lose, and when he loses, he's losing $975. And when the trader win, and there's only 5% chance he's going to win, he's going to make $25. You take this trade, right? When you lose 5% of the time, you're going to lose $975. When you win, you're going to win. When you win, right, there's 95% chance you're going to win. Sorry, 95% chance you're going to win. You're going to win $25. Are you going to take this trade? So if you use 0.95 times 25 minus 0.05 times 975, I believe you'll get a negative value, which means to say that even though you'll be very happy 95% of the chance you're making some money, but all you need is just 5% of the time you're going to burst your account. It's a negative edge. In the long run, you're going to lose money, right? So this kind of strategy tend to give false hope to traders, right? Thinking that they may win a lot of times, but they just need one time to lose all their money, and in the long run tend not to make a lot of money and to be unprofitable. Okay, so we look at all the things that we do in trading, in this kind of, using this kind of mental models: win rate, and also the risk reward, how much you expect to make when you win and how much you lose when you lose. So in our methodology in price action manipulation, okay, even for trade, our win rate is around 50 to 70 over percent. So for traders, right, for traders who have a risk reward of 1:2, so even if you average out a 50% win rate, you're still going to be profitable in the long run. Okay, of course, there'll be times when the win rate may drop to even 40%, but if you follow the 1:2 risk rewards, right, you tend to help you to defend your P&L until the winning streak comes along and you can make back all your money, right? So we look at the things that we do when I trade forex, futures, stocks, or even cryptocurrency. This is basically the mental models that I focus on, whether for short-term trading or even swing trading. Okay. So professional traders like us, we want to think of ourselves as basically we are the casino with the edge in the long run. And when we play the market, right, we decide when to go in. And we only go in when we see a high probability trade setup to achieve a net positive alpha in the long run. So basically, in terms of our methodology, our structure, right, based on my experience, the experience of my students is that we can achieve positive returns in the long run by engaging in the structures, right? Following not just the strategy, but also the risk management concept about on sizing and having the right mental model, the right mental psychology to manage the trade. Okay, and all traders must look at all trades set up as independent of the previous trade. Okay, so whether you win or lose for this trade, it shouldn't affect how much you go in, engage into the next trade. You still have to follow your rules, right? Follow your rules, strategy rules, follow your risk management rules, and so on. Okay, so this, for example, is a win rate box. Okay, that is like, for example, this will actually show a 60% win rate, but at times, I can actually show you over here. Let's say here is the win. Okay, this is the loss, and this is the win, right? There'll be times when let's say for example, you start trading and you have a win, you'll be very happy, and then suddenly there's a loss, and there's a loss. How many of you will give up after 3 trades like this, right? And then those who stay on, may experience things like a win, and a win. They'll be very happy, right? But suddenly there could be another loss, another loss, and another loss. Some trader may feel dejected because of they start to have 4 wins and now they have down 5 losses, right? Some people may give up along the way. And what if the losing streak continues? Lose. By now, in this kind of scenarios, a portion of traders will have left the game, right? But for professional traders like us, we will continue to do what we have to do, managing the risk, do the same trade, and we may see things like this, like win back, lose back, win back, lose, win, lose, lose, win, and so on. Basically, when you do a trade over a long period of time, there's going to be losses and there's going to be win. In the long run, you must accept that there's going to be some losses along the way, and I can tell you, good traders, like good traders, are very willing to put on the risk. We are very willing to risk, and even if we lose, we take it as a good attempt that we engage in the trade. When the trade setup has no reason not to go in, we will take it. Understand? And we believe, because we believe that in the long run we're going to be profitable when the winning streak comes along, and the game of probability, the positive edge will pan out. Okay, so just these are some risk management, portfolio management rules that when you do engage into the open up your stock trading positions, right? Never risk more than 2% of your account. So let's say you have a $10,000 account. 2% means it's about $200. You shouldn't go beyond $200. Actually, on average, I advise my students to go in around 1%. So if you have a $10,000 account, you're advised to go in and risk $100 per trade. Okay, of course, if you're more confident in you're more confident, you feel more confident about a particular trade, it's natural that traders may risk more, right? But at this stage, if you are very new to trading, stick to the standard guideline of 1 to 2%. Okay, there's sometimes I can tell you that because I've been trading for many years, there are times when I see a particular trade, I'm very super confident, fundamentally and even based on technicals, price action. I may risk like 5 or 10% or even 20% of my portfolio into the trade. But this is what professional traders like us we do, because we are grounded in our basic training already. So if you're very new, stick to these guidelines. Okay. So maximum exposure at all times shouldn't be more than 6%. So basically, it's about three positions if you are doing 2% risk. So if you are doing 1% risk, it shouldn't maximum exposure should be not more than 3 to 5%. It means 3 to 5 positions. Okay, and of course, review your trades. If you do have 5 consecutive drawdowns, review your trades. Ask yourself if you are following the strategy structures, the sweet spot entry. Are you chasing a trade, your sizing or risk management, and also mentally, are you fit to continue to do the next trade, right? Will this affect you when you do the next trade? And my advice is psychology is that the account that you put in and the size you do, you must be psychologically prepared to lose 20 times in a row. So let's say you risk, let's say $100, and 20 times is $2,000, and $2,000 to you is something that you can mentally continue to trade. This will be a good risk amount to start off with, which means to say that $100 is a good amount for you to start trading. Okay, if you find that after doing 1, 2, or 3 trades, or let's say per trade you risk $1,000, and by the third trade you feel psychology very heavy-hearted, you cannot click the button anymore. So this is basically not your size to begin with. You find a size that you're comfortable with and build your portfolio accordingly. Okay, in the long run, you do a size that allows you to test out trading. Okay, and then you don't feel obligated to size down if you have some losses. Okay, so you can actually download right the risk management Excel sheet in, I believe, over in the learning lessons here. You can actually download this risk management spreadsheet, and I'm going to explain to you basically how you do sizing for stocks. Okay, and just to recap, for stocks, okay, we are going to look at the 1 year 2 days chart or the 4 years 1 week chart for swing trading. Okay, so if you have not watched the previous video, I did mention that 1 year 2 days is recommended for doing swing trading, right, for stocks, because of the gaps. Day chart, 1 day chart has too much gaps, and so we want to combine some of the gaps to 1 year 2 day. Okay, it will be the best because we are looking for distinct strategy structure. Okay, so we're going to cover more on the strategy structure later on in specifically in the individual strategy video. Okay, so right now I'm going to cover more on basically how do you put in the orders, and how do you put in the OCO orders, and how do you do sizing. So we're going to simulate basically a setup. Okay, first. So let's go into the risk management. Okay, so you can read this up. Okay, slowly, and I'm just going to go through, basically go straight to an example while I use the Excel sheet and I coach you from here. For example, this stock called GCO, Genesco, right? 1 year 2 days chart. Okay, let's go on to the chart, and let's go on to the chart. Okay, let's go on to chart. So this is Genesco, right? Okay, let's say this is the bar. Okay, if you have watched, okay, this maybe I know it's a 1 year 2 days chart, but for purpose of letting you to see the what's on the left side of the chart, I'm going to expand the chart, right? So basically, this is a force top scenario. Okay, it's a force top scenario. This is what we call a UR1. Okay, so for UR1, we're looking at a majority flush to force the top. Okay, so like I mentioned, if you watch the strategy video on UR1, you will definitely understand what I'm talking about. Okay, so don't worry if you have not watched the video yet. I'm just going to explain it over here, basically to show you how we do the sizing. Okay, so let's say now for example, you understand what's a UR1. This will be your bearish ice cream bar execution signal. Let's say you want to enter the trade, okay, on the retracement to $49.33. Okay, let's say the price is like this, you have no idea where basically say when it forms, right? Because of the false stop, you want to do a short trade. And let's say your stop loss is at 52.21, right? Let's say 52.21, let's say is a stop loss. And you want to go short at 49.33. Okay, so sweet spot. Okay, you can watch the video on sweet spot, the subsequent video on sweet spot. I cover that more in details as well. Okay, so let's say you entered the sweet spot, this is a stop loss, you have a stop loss, you have your entry. Okay, you will use this Excel sheet under risk management tab, use the tab under this thing called find target level. Okay, find target level over here will shows you basically, right, once you have your stop loss and your target, your stop loss and your stop loss and your entry. So stop loss is $53.21. You key in here. I know here over here there is a find entry level section and a find target level section here. So find target section over here is when, okay, I'm going to explain it. Probably let me explain it over here first. Right? So all trades got three elements, right? Three elements. So when you decide what's your, let's say it's a long trade, right? Long entry. All trade got three elements, right? Entry, stop loss, and target. So you find target or you find entry. You're going to find target when you know what's your entry and your stop loss. You're going to find what's your target. All trades got three elements. Once you got two elements, you can find the third one. Okay, there are times when you have your target and your stop loss, you're going to find what's your entry. Based on both is based on your this thing called the risk reward. Depending on risk reward, you can configure your trade setup according to which variable you have. Okay, in the Excel sheet, there's two sections, find target and find entry. But most of the time, okay, you're going to use the find target section. Okay, so now we're going to focus just on the find target section. Okay. So let's say under find target section, I'm just going to zoom in here, find target section, because we have your stop loss, entry, short entry is at $49.33. Okay, dollar risk over here means how much you want to risk in this particular trade. Let's say in this particular trade you want to risk $200, so you can key into the dollar risk as 200. For stocks, you have to key in per tick as 1. Okay, for stocks, okay, you have to key in as per tick as 1. Okay, so very quickly the Excel sheet tells you that over here RR in green, if you want a risk reward of 2, you can key in as 2. If you want risk reward of 1.5, you can key in as 1.5. Okay, so if let's say by default you are aiming for 1:2, your target is at $41.57, and the size, how many shares you're going to short, is 51 shares. Of course, you cannot short 51.55 shares, you can short 51 shares or 52 shares, and we can probably round down to 51 shares. Okay, so the target is at $41.57, $41.57. Okay, so if you shorted here, right, at $49.33, your target is at 41.57. That's your target. Okay, and obviously the market did comes all the way down, right? Okay, after he do a very strong buy up to manipulate to take out the stop loss, the market tanked. Okay, so how do you put in this thing called the OCO order? Okay, so before I go into the OCO order, right, let me over here as well going to explain to you what is the OCO order. Okay, more details on the OCO order is at the bottom. It's at the bottom of the slides here. You can read out more about the OCO order placement. I'm just going to go through all these are the OCO order placement that you can slowly read through. So over here, follow me, I'm going to explain it over here in my slides here.